Welcome to datascience.show, the podcast where data science meets executive leadership. We talk with top AI and analytics thought leaders about turning data into real business impact. If you're a C-level leader or data expert shaping the future, you're in the right place.
I'm your host, Mirko. We explore how data science and AI drive real business impact, straight from the leaders making it happen. Today, Insuring AI, enterprise strategies for liability, risk transfer, and governance. Why this matters now? Organizations are embedding algorithmic decisions into finance, care delivery, and customer interactions. And when those systems fail, the financial and reputational consequences can be immediate and material. In this episode, I'll walk you through a practical playbook for executives, how to translate model failure modes into insurable exposures, how insurers think about underwriting technology risk, and what controls materially reduce premiums and defend you in court. Here's what to expect. We'll narrate 3 practical perspectives you should treat as collaborators: the chief risk officer at an insurer, the general counsel, and the head of ML Ops. And then move from strategy to execution with concrete contract language, observable controls, and a decision framework for retention versus transfer. By the end, you'll have 2 action items you can take to your next board or executive meeting. Before we dive in, a quick framing. Insurance is not a substitute for controls. Think of insurance as financing residual risk after you've reduced preventable failures. If you rely on a policy to excuse weak governance, you'll pay for it in premiums, exclusions, or worse, denied claims. The goal is to make insurance a lever that enables scale, not a Band-Aid.
Now, let's set the table with the 3 narrated perspectives I'll reference throughout the episode. First, the chief risk officer at an insurer. Their job is to convert uncertainty into priced risk. They ask, what are your loss scenarios? What's your loss history? And what operational controls demonstrate that this loss is unlikely? They care deeply about reproducible evidence, audit trails, test coverage, and incident postmortems.
Second, the general counsel. Their priority is allocating liability across contracts, preserving indemnities, and avoiding unconscionable caps. They focus on exclusions, regulatory fines, punitive damages, and insolvency carve-outs, and on drafting vendor clauses that require demonstrable controls and audit rights.
Third, the head of ML Ops. Operationally, they own observability, deployment discipline, and incident response. They translate model failure modes into technical mitigations, monitoring drift, labeling bias alerts, rollback paths, and reproducible pipelines. Put simply, they own the telemetry the insurer will ask for.
With those 3 perspectives in mind, let's map AI failure modes to insurable exposures. Consider 3 common failure types: incorrect prediction leading to financial loss, discriminatory or regulatory non-compliance exposure, and operational outages that interrupt service. Each maps differently to insurance products. For incorrect predictions, think a credit model declining qualified applicants, or a pricing model that misprices trades. The primary exposure is financial loss to customers or counterparties. Insurers treat this as technology E&O, or errors and omissions, or professional liability. They want expected loss estimates tied to model error rates and business exposure, and evidence you test across edge cases and adversarial inputs. For discriminatory outcomes or regulatory breaches, think biased hiring screens or privacy violations. The exposure can include regulatory fines, injunctions, and class action suits. Many carriers exclude regulatory fines from standard policies, so you need tailored coverage or explicit indemnities. The GC must push for clarity on exclusions and consider captive solutions or layered towers to cover regulatory gaps.
Operational outages and third-party dependency failures are often covered under cyber or technology policies, but the underwriting focus is on redundancy, SLAs, and incident response playbooks. Insurers will ask, can you isolate faults, roll back models safely, and notify affected parties within contractual timeframes? If your ML Ops team cannot demonstrate a tested rollback plan, premiums increase or coverage is limited.
Next, retention versus transfer. Retention is when the firm self-insures part of the risk. Higher retention lowers premium but increases capital reserved for potential losses. Transfer shifts risk to insurers at a cost. The right mix depends on three variables: loss frequency, loss severity, and the firm's appetite and capital position. For low-frequency, high-severity events, example, catastrophic model failure in a trading book, transfer makes sense.
Underwriting signals. These are the controls that materially move the needle on price and insurability. Top signals include comprehensive audit logs tied to model versions, end-to-end test suites including adversarial and fairness tests, real-world monitoring and drift detection, documented incident response and RCA processes, and clear governance with executive sign-off on material models. If you can present metrics, percent test coverage, time to detect, mean time to recover, underwriters can convert those into pricing models.
Let me give 3 short industry vignettes. Fintech. A lending platform ties underwriting to several third-party models. The insurer required contractual indemnities from the vendor and proof of model validation tests covering macro-stress scenarios. Healthcare. A triage model misclassifies a high-risk patient. The carrier wanted explicit clinical validation, a human-in-the-loop escalation path, and an agreement that regulatory fines were covered under a layered policy. Commerce. A pricing model pushed illegal surcharges in a jurisdiction. The company needed cyber tech E&O with regulatory carve-ins, plus PR expense coverage for reputational remediation. Each case shows the insurer negotiates both technical evidence and contract language. Now, the contract playbook. General counsel should standardize 3 clauses: indemnity scope with explicit definitions of covered harms, limits and retention with carve-outs for regulatory fines unless separately purchased, and control warranties tied to observable evidence. For example, a warranty that production models run with immutable audit logs and monthly drift reports. Importantly, avoid open-ended indemnities for third-party vendor failures without reciprocal protections. Leadership and organizational implications. Who owns these decisions? My recommendation: make AI liability a shared executive decision with clear accountable owners. The CRO owns capital allocation and insurance buying. The GC owns contract language and regulatory exposure. The CDO, or head of MLOps, owns controls and observability. Put these 3 into a standing risk committee that reviews material models above a threshold of business impact.
Budgeting. Insurers like to see you budget both premiums and retained capital. Treat premiums as the cost of risk transfer and reserves as the capital buffer for retained exposure. KPI examples to report to the board: expected annual loss, EAL, per model, percent of material models covered by insurance, mean time to detect model failure, and percent of models with documented post-deployment audits. These KPIs translate technical controls into financial metrics the board understands. Looking ahead, the market and regulatory landscape over the next 12 to 24 months. Expect insurers to increasingly require standardized evidence, model registries, immutable logs, and third-party model audits. Regulators will push transparency and may mandate minimum liability standards in some jurisdictions. That will change pricing and may make some risks uninsurable unless you adopt strong controls quickly. My practical advice: prioritize establishing observability and robust documentation now. It's the low-hanging fruit that preserves insurability.
2 actionable checklist items you can take back tomorrow. 1. Build a risk quantification template that maps each material model to specific loss scenarios, an estimated probability, and an expected loss. Use that to inform retention levels and premium appetite. 2. Standardize vendor contract language that conditions indemnities on demonstrable controls and gives you audit rights. Require evidence, logs, tests, and governance reports as part of procurement acceptance. Those 2 steps alone will materially improve your pricing and defensive posture.
Final reflection. Treat insurance as part of an integrated risk program, not as an escape hatch. When you link model governance, observability, and contractual allocation to financial measurements, insurance becomes a strategic tool that enables scale instead of masking weak controls.
That's the difference between models and value. If you found this episode valuable, subscribe and share it with your network. And let's connect on LinkedIn. I'm Mirko Peters. We'll be back with more conversations on how data science and AI create real business impact. Until next time.
Thanks for listening to datascience.show. If you found value in this episode, subscribe, share it with your network, and join us next time as we explore how data science drives smarter decisions and better business outcomes.